Welcome, everyone. Today, we're kicking off Chapter 1 of our financial education, the basics of the stock market, the journey of a share. Look, if flashing red and green numbers on TV make your head spin, don't worry, you are in exactly the right place. We're going to trace the complete journey of a share together, breaking down how this whole world actually works, right from the ground up.
Here is our roadmap for today. We'll be hitting 1. Why the market exists. 2. What is a share? 3. Primary market and IPOs. 4. Where do we trade? And 5. Getting started safely. Let's jump right in.
Section 1. Why the market exists.
So why should you even care about stocks? I mean, why not just stash your hard-earned cash under a mattress or leave it sitting in a basic savings account? Well, because cash sitting still is actually losing value. It's crazy, but we're constantly fighting this invisible enemy called inflation. Historically, though, broad market indices have delivered average annual returns of around 7 to 10% after inflation over decades. So the stock market isn't just some optional casino. It's literally your shield against rising costs, and honestly, one of the absolute best vehicles out there for long-term wealth creation.
It helps to think of the stock market like a massive, mutually beneficial bridge. On one side, you've got companies, right? And they need a ton of capital for business expansion, building new factories, R&D, or just reducing debt. Instead of taking on heavy bank loans, they raise this money through the market. On the other side of that bridge, you've got investors, people exactly like us who want to build long-term wealth, earn dividends, beat inflation, and maybe create some passive income. The market just connects their need for cash with our need for growth. It's a perfect match.
Moving on to Section 2, what is a share?
Okay, so a share is exactly what it sounds like, a unit of ownership in a company, representing a proportional claim on its assets, profits, and future growth. I really want this to sink in for a second. When you buy a share, you aren't just buying a glowing ticker symbol on your phone. No way. You're becoming a legally recognized, actual part owner of a real operating business. If that company succeeds and grows, well, your slice of the pie grows right along with it.
Let's put some real numbers to this to make it concrete. Imagine a company, let's call it XYZ Limited, and it's valued at 500 crore rupees total. They decide to issue 5 crore shares to the public. If we do the simple math, 500 crore divided by 5 crore, we get exactly 100 rupees per share. So, if you invest 1 lakh rupees, you are buying exactly 1,000 shares of XYZ Limited. You literally own a mathematical fraction of that entire enterprise. How cool is that?
Now, once those shares are out in the wild, their 100 rupee price is going to start moving based on the super simple rule of demand and supply. Let's look at a few scenarios. In scenario 1, you have 10,000 buyers trying to buy from only 5,000 sellers. Demand is high, so naturally the price goes up. In scenario 2, you only have 4,000 buyers, but 12,000 sellers rushing to offload their shares. Supply is way bigger, so the price falls. And in scenario 3, if buyers and sellers are equal, the price just remains stable. Honestly, every single fluctuation you see on the financial news is just thousands of these little supply and demand battles happening every single second.
Which brings us to Section 3, primary market and IPOs.
You got to understand, there are two totally different environments here. First is the primary market. This is where companies issue fresh shares for the very first time, and the money you pay goes directly into the company's bank account to fund their growth. But the secondary market is where investors trade already issued shares among themselves. If you buy a stock on an app today, you're buying it from another investor who's selling it. The company itself doesn't see a single rupee of that specific secondary trade.
And this brings us to the famous initial public offering, or IPO. This is the grand debut. It's the exact moment a private company becomes publicly listed. Why do they do this? Well, it raises massive business capital all at once, dramatically improves their credibility and brand recognition, and it provides liquidity to those early investors who backed them from day one.
All right, Section 4, where do we trade? We trade on a stock exchange. This is a highly regulated, secure, and transparent marketplace where securities are bought and sold. I know movies love to show the stock market as this chaotic, screaming, smoke-filled room where everyone's just gambling blindly. Actually, scratch that. It's nothing like that today. Today's modern market is a tightly monitored, digital environment built on incredible tech, specifically designed for absolute fairness. In India, almost all of this happens on 2 major exchanges. First up, the National Stock Exchange, or NSE. Established in 1992, it's fully electronic, has super high liquidity, and is home to the famous Nifty 50 index. Then you have the Bombay Stock Exchange, or BSE. Established way back in 1875, it's Asia's oldest exchange and home to the Sensex index and literally thousands of listed companies. Most major companies are actually listed on both, so you can seamlessly trade across either one.
Finally, Section 5, getting started safely.
To keep this massive ecosystem fair, we rely on the Securities and Exchange Board of India, or SEBI. Think of SEBI as the strict referee of the whole financial game. Their absolute main job is to protect investors like you. They actively hunt down and prevent fraud and market manipulation, they heavily regulate the stock exchanges, and they monitor brokers to ensure fair and transparent trading. I'll be honest, without SEBI acting as the tough cop on the beat, the investor confidence we all rely on would just straight up vanish.
So how do you actually hold these shares securely today? Through the DMAT process. Look, the days of keeping easily damaged physical paper certificates in a safe are totally gone. Today, it's a seamless three-step process. Step 1. You, the investor, place an order on your app. Step 2. Your depository participant, meaning your broker, instantly routes that order to the exchange. Step 3. A central depository like NSDL or CDSL electronically credits or debits those shares right from your DMAT account. It's a completely secure, instant electronic chain of custody. No paper, no stress.
We have covered a lot today. We've traced the journey of a share from its creation in an IPO all the way to your digital portfolio. You've got the fundamental building blocks now. The market isn't some huge mystery anymore. It's literally a bridge to wealth. So, here's my final question for you. Are you going to let inflation just slowly chip away at your hard-earned savings, or are you ready to take that first step across the bridge and start observing the markets? Thank you so much for joining me on this explainer, and keep learning.